Welcome to another episode of Investing with IBD, the podcast. It's Justin Nielsen here, and it's Wednesday, February 14th, 2024. We've got a special Valentine's Day episode for you. So we're going to have a little fun with it, call it our Valentine's Day special. The fact is, look, relationships have their ups and downs, and our relationships with stocks, of course, can take that even more literally. So we often talk about the old stock market adage, you want to date your stocks, not marry them. So how do you decide when it's time to call it quits and move on to your next squeeze? So, or as the Clash would say, darling, you got to let me know, should I stay or should I go? And to help me out with today's episode, as he always does, it's Irusha Peiris. He is my stock market therapist and, of course, a portfolio manager at O'Neill Global Advisors. How are you doing, Irusha?
I'm doing well, Justin. Happy Valentine's Day to you and all the listeners, and especially our producer, Mike.
Yes, exactly. So, yeah, he's trying to make us get this done so he can actually have a Valentine's Day himself, because he's on the East Coast, and of course, it's sure we'll try and get you out of here soon enough. But yeah, let's go ahead and start with the market because, I mean, the fact is, when things are this good, it's really hard to think about calling it quits. I mean, you're seeing so many stocks that are looking so phenomenal, and I don't know. What's your take on the market? I mean, you look at the NASDAQ composite, and of course, we had yesterday the CPI report came out, and it was a little bit hotter than expected. I think overall, it's still coming down in the right direction, but the fact that so many people are getting so excited about when those cuts are going to happen by the Fed, it did kind of shake things up. But it seems like every time we get a one-day shakeup, we're right back at highs within a couple days. Do you think that's going to be the case this time around?
It's always hard to say, but that's that, as you said. I mean, that's the character of the stock market right now. Every time it happens, I think there's no way it's going to happen again, and it seems like it does it again. So I think you have to default to, it should hold around here, right? That's been the character. If it breaks, then that's a change of character. That's really the best way to do it, instead of kind of assuming one way or the other. Of course, when you have a day like yesterday, it's very easy to get emotional and get scared and say this is the top of this, and we're probably due for some kind of pullback. So we'll have to wait and see on that. I think the key, though, is that 21-day moving average. You guys highlight it all the time on IBD Live. And I think, how does it behave there? And it hasn't even touched it yet. So if it were to break that, now that might say that, okay, the market might need a rest, our kind of stocks might need a rest, and it just might be time for some new bases to build.
Yeah. And as bad as yesterday was, I mean, again, it felt like a decent clobbering. The NASDAQ composite only came down to the 10-day moving average line, not even to the 21-day.
Yeah.
It got support at the 10-day moving average line, which has held a lot of this move so far. I mean, the 21-day definitely. The 10-day has held a lot of the move. You had the kind of breakdown to start the year. One little test after that. You had a couple weeks ago. Again, came down after the Fed meeting, and then right back up in 2 days, back to new high territory. But let's turn our attention to the Russell 2000, because the small cap index is a lot more interest sensitive. And if you look at the weekly chart, it's obvious that 2000 is one of the important areas for the Russell 2000. I mean, that 2000 level, it hit its head so many times on that level, and then got turned away. Briefly had a moment above it for a couple weeks, back down to the 10-week moving average line. And now we got above the 2000 level again, got immediately rejected. CPI came in. This had, I mean, if you go back to the daily, we had these 3 days of 1.5% plus gains. Boom, boom, boom. And then the CPI report, kind of took it all away in a single day. I mean, that was down almost 4% in yesterday's action. So we've been talking about breadth, and it'd be nice to have the small caps kind of get in there a little bit and participate as well. Do you think this? I mean, it got support at the 50-day. Do you think it's still viable?
Yeah, here's the crazy thing. This is still pretty much normal action for which now maybe the last few days with how strong, how volatile it's been. But this obviously went from 1633 up to 2071, and it's been consolidating that move this whole time. And it's starting to get a little bit tighter. The range is starting to get a little bit tighter. And so I think you definitely can see it a little bit better on the weekly chart where you have that strong prior uptrend, and it's almost building a little bit of a cup here pattern. So I think it is for the most part pretty normal action, and it looks like it's just been consolidating that move and trying to set up a new base that maybe it can emerge out of and finally establish a support level above 2000.
Yeah, and so let's go ahead and take a look at the breadth. I mean, if you kind of want to be not to twist the relationship analogy too much, but if you want to be playing the field, you'd like to have a lot of field to play off of. And if you look at GMI which is the NYSE advanced decline line, we are still above that 10-week, I'm sorry, the 10-day moving average line. And certainly, today's action is going to help that a little bit. Yesterday was, gosh, I can't remember the last time I saw. I think it was like 13-1 decliners over advancers. I mean, it was just so skewed, in favor of decliners yesterday. But today, again, a bounce back. This is back above its 10-day line. Is this how much attention are you paying to the advanced decline line right now?
I'm not paying that much attention at all. Now, I think it is interesting that you are seeing more broader participation. And honestly, I mean, I feel like there has been enough participation, even though the Russell hasn't participated just yet. You've had it's broader than last year, right? Remember, last year was just a handful of stocks that were carrying and everything. This time around, you are seeing more stocks participate. It's just still in a small amount of sectors. I think that's the bigger issue here. And so it's just, hey, if you're in tech, you're loving it right now. If you're in a lot of other things, you're getting frustrated. So yeah, I don't pay too much attention to this every day. I'll take a look at it every few days or so. But in the end, it's those underlying stocks, and a number of those technology stocks, those fast-moving, high-growth stocks, and more tilted towards larger caps stocks, they've been working pretty well.
Well, one of the things that's kind of interesting is, and if you go to XLK, I mean, obviously, you break down the S&P 500 into, what the 11 sectors, and XLK is by far that's where the action is. But you look at XLI, for instance, the industrial sector, that doesn't look too bad. I mean, that's, that looks pretty decent. You look at XLV, and especially on the weekly chart, this looks like a big long base that we're potentially just coming out of right now. Now, granted, the relative strength is poor on this. The relative strength line has been in a downtrend because it just hasn't participated. But this is a really long base that it's potentially coming out of. You look at XLF, and despite all of the the action that was kind of brought on by New York community, NYCB, and the KRE having another tough time because of that New York community, Bancorp, XLF doesn't look bad. I mean, it's really shaking off that whole weakness in the regional bank area. A lot of tight action, support at the 10-week moving average line. Again, the relative strength, not great because it just hasn't been performing as well as the S&P 500. That's what the relative strength line is comparing it against. The S&P 500, which is so tech heavy right now at the top. It's almost right there with the NASDAQ, not quite, but it's up there. So, I mean, should we be looking at potential sector rotation if the tech area takes a break? Are all of these poised to maybe pick up the slack?
Potentially, but I think with some of these areas like XLF, it's still heavily leaned towards the large cap, right? So the large banks, look at JP Morgan, and stocks like that. They're the ones that seem to be carrying these sectors here. So yeah, you could see that rotation, and so I think it's possible, but I don't think you want to necessarily be rushing into it,
Mhm.
because I feel like there have been a few other opportunities where everyone's tried to rush into this rotation and assume that tech is going to rotate out and take a break, and they've been left behind, because tech all of a sudden, as we saw with the markets, they bounce back so fast. So I think, yes, you can add that rotation, but let those stocks really prove themselves before slowly starting to move to them.
Yeah, and to your point, for XLF, JP Morgan is number 2 in terms of the weighting. It is at like 9.4. Berkshire Hathaway, BRKB, and I do have a position in Berkshire, just a small one to kind of diversify a little bit. That's the biggest weight, at 13%, and you also have Visa and Mastercard,
Yep.
together making about 15%. And I mean, Visa and Mastercard have both been looking really strong. I mean, these have been holding above their 21-day moving average lines. Just like the market. Maybe not as big a moves, but nice and steady.
They're the perfect type of stocks to have in the portfolio as a counterweight, right?
Mhm.
I mean, with low betas and they just slowly crawl up, it enables you to get a little bit more aggressive in maybe some of the faster moving stocks, because like the Visa and Mastercards are just slowly crawl up. I mean, honestly, looking back, I wish I bought some of this to put in there, but I always have a tendency to try to go for some of the faster moving ones.
Mhm. So, of course, we got to talk about the stocks that are really getting the love. Tech, as we've mentioned, the Magnificent Seven, or I mean, if you look at FNGS, which represents the Fang stocks, I mean, this has been on a really strong tear. Um,
Yeah.
I mean, again, to your point, should we just be sticking with what's working? Should we just be sticking with the pretty ones out there?
Well, it depends. Yeah, I mean, if I think if I mean the way I look at it, and the way that I've been trying to do it is, I try to pick one or two stocks to try to give more room to
Hmm.
pull back, to build new bases. A lot of the other stocks, if they're up that 15-20%, I'm trying to be a little bit more aggressive in locking in gains. Now, looking back, I wish I didn't, for some of these stocks, so they kept going up. But that's not always the case. But I've just more to kind of reduce the volatility in just kind of the larger equity curve. I've been trying to do that, and I think for the most part that's the way to do it. So you kind of have a little bit of a balance. So then, yeah, then you free up some of that money naturally, because you're trying to sell some of those stocks. You're locking in some of the gains in some of those stocks, and then you can move into to some of those other ones. But there are a few big time leaders in this market, and if you have one of them, and you have a lot of conviction in it, and you have a good cushion on it, you can lighten up on it, but you probably don't want to completely get out of that position. You want to try to give it a little bit more of a chance.
Mhm. Let's talk a little bit about this earnings season. I think in the past year here, we were maybe a little bit more hesitant to hold through earnings because we just didn't have as much cushion on things. If you had some of these winners from last year, maybe you could do it, but it was a little bit tougher. I feel like it's been a little bit more comfortable for me to hold through earnings this time around because I had more cushion. Things seem to be rowing in the right direction. And there have been a lot of earnings reports that have not only rewarded you, but I mean, could have changed your portfolio completely. And I'm thinking of stocks like Meta, for instance, when
Yep.
it had its big move. Arm Holdings, up 50% in a day after its earnings. And there have been a lot where 20% just seems to be like, oh, okay, yeah, that's that's normal. It's norm here. And as much as I was kind of thinking earnings season was over. I mean, even this week, we're still having a lot of uh, stocks coming out with their earnings that are really kind of having some big moves. So, are you kind of treating earnings reports, earnings season a little bit differently this time around?
I'm a little bit more willing to hold through earnings with just the way the behavior is this time around. So yeah, usually I'll lighten up, and it's same thing. I'm still going to lighten up if I don't have a big enough cushion in it. But for those stocks that I have conviction in, I'm going to try to give it a chance because of the environment. In the end, I think you're seeing all these gap ups. Obviously, we're in an environment where even the ones that are gapping down, they've been forgiven a lot of times. Maybe they have that big gap, like I think of like a Pinterest, right,
Hmm.
where Pinterest gap down, and it's still kind of hanging in there.
It at
I'm
least
drawing a blank.
stopped the selling instead of continuing.
Last, yeah, that isn't like there was another one that gapped down massively and started to recover a lot of those gains. I can't remember.
Monday.com, I mean, that's an
Monday.com might be one
example.
of them. Yeah,
It got down on its
there you
earnings
go.
and a decent
Perfect.
amount, and
Yep.
it's now filling in that gap.
And
So
when you look on the weekly chart, you're like, hey, you know what? It's closing in near
support
the
at the
top
10
of the
week.
range. Exactly.
Right.
Exactly. So we're in that environment where it is a forgiving environment.
Mhm.
And a lot of times that's how you want to look at it. Really, the key is the first stock that I really try to pay attention to is Netflix, because they're usually one of the first tech stocks to report. And so when you saw like a Netflix open up, I mean, they gapped up pretty big. That was to me like, okay, maybe we'll have a more forgiving earnings season
Mhm.
this time around. I mean, there have been times, and I've been in Netflix in years past, where they've gapped down massively, and I
Yeah.
didn't take advantage. I didn't listen to what the market was saying. I think it was like 2018. Netflix gapped down big, and then I was like, oh, maybe let me hold Meta the next day, and that gapped down big, even bigger,
Mhm.
right? So,
Mhm.
I like using Netflix as a gauge, because I think that's generally like one of the first technology stocks. So I like just to take a look at it and say, okay, how are they treating this? Maybe that bodes well for the others. I mean, obviously, there's not. I mean, there's not a lot of science to that, but it's just kind of your first glimpse at maybe the environment will be a little bit more forgiving
Mhm.
towards some of these reports.
Mhm. And last question, just kind of on this earnings topic. There have been kind of, I feel like with these strong gaps, there have been kind of a couple ways that they go. Like Netflix, and I do have a position in Netflix myself. It kind of gaps up and then it kind of holds,
Yeah.
kind of almost builds a nice little flat area and potentially goes again. I feel like Meta is doing a similar thing,
Yep.
where it had that big gap up and it's just holding tight right now. And then you have something like SMCI, where it came out with kind of preliminary earnings, then its actual earnings, which you would have thought, oh, well, it probably got this, it probably got the air kind of, taken out of it already because of the pre-announcement. But no, it was up a good amount on earnings. And this thing just hasn't stopped. I mean, up 11% today. Uh, and yesterday it was up. The market is down,
I
everything is
know.
down, and this was just up still. So, and any kind of insight into this difference, and how do you get into more of these?
Well, I mean, yeah, it's. I think though the one way to increase your probability of getting into one of these is seeing how it behaved before, right? And this is not the first time. It went on a monster run last year too,
Yeah. Hmm.
right? The hard part about the markets is you see these stocks and you're like, oh man, I wish I could. I wish I was in an SMCI right now. And then, like a few months later, 3, 4 months later, it might give you another chance, but you forget, right? That you wish at that point, because you moved on to other stocks.
Hmm.
And so the key is to have that watch list and to remind yourself when hey, what I like these for this reason. Because that I honestly, I think in many ways, that's for me personally, that has been one of the hardest things that uh, is keeping track of some of the stocks,
Yeah.
where it might be like, I mean, SMCI went sideways for like what, 5, 6 months or so, right? And so it took some time, but then it just kind of tightened up. And now, would have imagined that it was going to do this? No. But did it have the potential to go on another pretty decent run? Yeah, I think it had definitely had that potential if it was able to break out of this consolidation again. Especially with when you look at the story and all this kind of stuff, they're just so
Mhm.
well positioned for that. So I think the key is, a lot of times, and David Ryan said that uh, plenty of times in the past, right? A lot of stocks that you might miss the first double, but put it on a watch list and try, and you might be able to get this next time it doubles, right? So I think that's probably the closest thing to do to try to increase your probabilities of it. But these are obviously once every year, once every few
Right.
years. I
Yeah.
mean, it is this is one of the best runs I've ever seen. This is
Yeah.
like, it's up 147% in 6 weeks, and I can promise you, because when it came down to the 50-day, I was really thinking about getting into it, but I just didn't pull the trigger. I probably would have sold it that first day
Oh,
when it
yeah.
broke out, because it was
Mhm.
up 35% at that day, and I probably was like, you know what, let me just take that gift
Yeah.
at that
Mhm.
point. So it's hard to imagine some of these stocks running this much, but I think the key is put it on a watch list, let it settle down, and when it sets up again, take a shot then, and
Mhm.
keep a tight stop too, right? Because I mean, it's already gone on a massive run,
Yeah.
so there's a lot of expectations going into the next quarter.
And potential drawdown that could be pretty serious if you try to buy
Yes.
this extended. You always have to be very cognizant of that. So let's go ahead and take a break real quick. And when we come back, we're going to talk a little bit more about these stocks that it's really easy to fall in love with. Stay tuned. We'll be right back. Welcome back to the Investing with IBD podcast. It's Justin Nielsen here, your host, and it's a little bit of we time on this special Valentine's Day episode. So, of course, helping me out, as he does every week, is Irusha Peiris, one of the portfolio managers over at O'Neill Global Advisors, also an analyst over there. So, let's get into this a little bit more, this whole idea of should I stay or should I go? And also, I mean, look, we're not the young spring chickens that we were, Arusha, and playing the field is a little bit harder. So sometimes it's better to kind of concentrate your attention on a single stock or few, as opposed to trying to date everybody out there. So how do you go about really kind of making that decision of this is the stock or these are the stocks, that one or two that are special, that I'm going to treat differently than, let's say, as you mentioned, the 15-20% gains that you're going to take here? So what distinguishes those?
It really just comes down to your understanding of the company, and it can be very tough sometimes.
Hmm.
Sometimes when you're in a strong market and everything's going, I mean, and we are in a strong market, not everything's going, but there are a bunch of things going still.
Yeah.
Um, a lot of times what I'll do is I'll shoot first, ask questions later, right? Where it's like things are breaking out. Okay, let me get positions, then do the research if I haven't had time to do the research. But what I've found over the years, the ones that I'm able to hold the longest are the ones that I just understand the story a lot better. One stock that I own now, like I think like everyone probably owns, is Nvidia.
Hmm.
That one,
I have a position as well.
yeah. So yeah, I would hope so if you're on IBD Live
Right.
pretty much every day. But for me, that has been one of the stocks that I've been able to hold for a while, because I just understood the story, right? It was just, hey, this
Hmm.
is picks and shovels playing AI. We're all familiar with Nvidia. Nvidia's gone on some amazing runs in the past. It was just that familiarity, and it's a large liquid stock. Now, could I have imagined it was going to do it this well? No. And did I sell a bunch of it at points where it was way too early? Yes, right. So
Hmm.
sometimes it's just really hard to know how far they can go. But having at least some of that position there, especially when it was going through the base building process, right? It took like 5-6 months off.
Yeah.
Uh, During that time, I still held on to some shares, uh, and what I found is that really helped me get back into it quicker when it was ready to go again, right? And there
Hmm.
were a couple of fits and starts on it, but so yeah, so in years past, I mentioned Shopify. In the past, like that was like for me in 2020 and maybe 2019, I can't remember. But I just read a bunch. I read about the story. It made sense to me, and because I had more of a tech background, and so that kind of stuff made sense to me. So there are a couple of keys. First, you need to understand the story. Second, you need a lot of times the best ideas where you're going to develop that conviction are ideas that are right in front of you, right? So you
Hmm.
might be using some of these products, and or you might have industry expertise. I remember looking at years ago at some chemical stocks, and I think GTLS, right? Chart Industries, right? I was looking at that stock like years ago. I'll switch over to the monthly chart, and it was probably back here in 2011, 2012 when it was doing well there. And I was looking at like their distillation processes and all this kind of stuff, and I was like, I have no idea what they're talking about here.
Right.
Right. So it's like, I don't know why this distillation process is better than this one. Right. But I'll tell you what, some chemists could say, would give you 100 ideas why Chart Industries is doing well versus someone else. So, so you have to realize that you're not going to understand every leader. You don't need to understand every leader. And where you're going to have a higher probability of are within industries that you understand or products and services that you're using.
Mm-hmm. Yeah, and I think that there is kind of this combination too. I mean, if we're going to use the Valentine's Day analogy, when you kind of are getting to know the story, you're getting to know a little bit about the personality, the what makes a person tick. So there is kind of like that feeling of getting to know the insides. The insides are so important, not just how attractive they look, but you look at the chart, and I think that's kind of like, hey, this looks pretty too. So when you have both of them, where, hey, this has something really, good head on its shoulders, good management, all of these great fundamentals, and the chart is there and it looks pretty too. I think that's kind of when you've got the best of both worlds. And certainly, you're going to have those stocks where you have maybe a little bit more commonality. You understand the story a little bit, as opposed to, like, if I'm, if I'm looking at a potential partner, and let's say they went to USC. I mean, what am I going to have in common with them as opposed to someone that went to UCLA, right? So there are those things where I can understand you a little bit better, when you're in the right industry, I guess. Does that sound about right?
Yeah, I would add that you're going a lot of times the way you'll find a leader initially, and you wouldn't realize it might be the next big leader, right? Is
Mhm.
through the chart. You'll
Yeah,
see a beautiful pattern forming. You'll see a very strong relative strength line.
that's the
So you're
initial attraction.
exactly you're
Yeah.
using the charts to screen and
Mhm.
identify stocks with potential, but to be able to have a chance to hold on to them, that's where understanding the story and developing that conviction comes in. Because I'll tell you, I've over the last 15, 20 years, I've been in probably every big time winner
Yeah.
or many of them. But the ones that I got shaken out of pretty early, I didn't really understand fundamentally
Mhm.
and what was going on with the company and how much of a game changing event was taking place there, right? And
It's
that's
always easy
tough.
in hindsight.
It's always
In
easy in
hindsight,
hindsight,
you're like,
but
oh,
that
of course.
exactly. But and the reality is during like for some of those major game changing stocks, no one understands how big this is
Mhm.
getting, right?
Mhm.
People back in the day for Apple back in 2003, 2000, when I think it was 2004, right? Broke out of
Yeah,
the
it broke
cup
out in
handle there,
2004.
right?
Mhm.
I was buying it at that point,
Mhm.
and I was like, I think that looks like a cup of the handle. It's a lot of big volume, and all I know is they have this really expensive iPod player there, but I didn't really understand. And once again, I don't think the market really understood until after a few more quarters you started seeing the revenue coming in. They were gonna, and then of course the iPhone and all the other stuff too. So it's hard for anyone to understand, which is why analysts are always going to be behind the game for the most part, right? They're generally going to be behind these things because the markets are going to they're going to move a lot quicker. The stocks are going to move a lot quicker before a lot of these things are priced in. So I think you're using the charts, then you have to develop the conviction, and then you have to have some kind of rules to try to keep you in some of the stocks, right? And it doesn't have to be every stock.
Right.
Like when I started out initially, every stock I bought, I thought was going to be another monster winner, right? It's like you see all
I'm
those
with you.
examples, right? That you probably worked on with Bill. All these
Uh-huh.
examples of going monster moves, like, hey, you know what? They all work. The
Yeah.
reality is most of them are going to go up that 20% or so, then correct and build new bases. But which ones are breaking out really powerfully, which ones have those monster earnings and sales, strong relative strength, and I think a lot of times which ones right out of the gate are you up big
Mhm.
on, right? That tells you a lot. So it's all those kind of little characteristics that could give you an idea of, hey, you know what? This is behaving like a leader. Maybe it's not going to end up being a leader, but behaving like a leader. Let me try to do a little bit more conviction to give me a little bit more staying power, because when they come in, it's gonna be heartbreak, right? If we're going with the Valentine's thing, it's gonna be heartbreak, and it's mortifying to watch if that stock corrects 30-40%, or even 30%, say goes through
Yeah.
a normal kind of base building process. You're going to be anchoring on to how much money you had, and now you've given
Hmm.
30% of that money back in that stock.
Right.
It's going to be it can be pretty tough at that time.
Hmm. Well, and let's go ahead and sticking with the Nvidia example. And again, we both have positions in it now, but I I did not hold through that 70% plus correction that we had. And by the way, in Nvidia, I will also say this is one that I bought in 2016. I
Me
bought it
too.
like in the 30s, and I think split adjusted, that's like around 8. So
Yeah, yeah.
yeah,
I can show you exactly where I
oh, I came out of a
initially.
cup with handle in
It
March
came out with a cup and
2016.
handle, but it was within that. There was an
Hmm.
earnings gap, and it was the week of February 19th, 2016. It
Hmm.
came out of there, and that's where it was came on right. And I think I bought it probably right around that March 18th,
I
2016,
was
where
right
you were buying it too,
right
right?
there with you. Yeah.
Yeah, and back then I was even telling people at markets, I was like, I like this name. I think this is
Hmm.
kind of interesting. But it was like a gaming chip, and it was still once
Yeah.
again, it was
It
hard.
was the GPU. It was GPU. That was it.
But it was
Gaming.
hard to understand how
Yeah.
much it can grow, right? But
Mhm.
the first way it came on my radar was the chart, was that earnings gap within kind of the base, where it's like, wow, they reported really strong, had this massive reaction. So that initially tells you that Wall Street's behind the story, right?
Mhm.
And they're trying to struggle to catch up to it. And then the next earnings quarter it had another massive gap, and so now more of Wall Street's behind the story, right? So it's a lot of times the best leaders are going to have some really powerful earnings reactions early in their move.
Yeah. And it's really interesting that, again, gaming was really kind of such a big part of it. But in order for you to get those smooth gaming transitions, especially with the graphics now, I mean, look, I think we both remember what Pong was like, and the graphics were
Yes.
just not that,
Yes.
fabulous. But now, there's so many calculations that are required to get those smooth moves in your graphics. These chips that can do all of those calculations are useful for AI, automated driving, crypto mining when you're having to do these very complicated, solve these complicated problems. There's just a lot there. But you know, again, this is a stock that I think we all would love to marry, but there have been times where, gosh, you know what? Maybe we just need a break, because Nvidia has had some pretty big downturns. Again, most recently, in this last bear market, I mean, over 70%. So when do you kind of make that decision? Like, oh, you know what? This is maybe not done forever, but it's done for now. And I will say, Bill O'Neill, founder of Investors Business Daily, I saw him say a number of times, Apple, you know what? I think I've gotten everything I can out of it.
Mhm.
And then
Yep.
a few months later, or even longer, he's back in it because it's like now it's a new base setup, and I'm on board. So, can you talk a little bit about that, when maybe something that you really did have the conviction in, you just don't stay around for the downturn?
Yeah, I think the end of 2021 is a perfect example. I think we were probably all in Nvidia back then too,
Yeah.
right?
Hmm.
And we all got out of it when it was breaking the 50-day on heavy volume, when the market was going into a correction. We didn't know it was going to be this severe bear market at that time, but we knew that it was starting to trigger a lot of major sell signals for us. And it wasn't just Nvidia; it was a lot of stocks
Yeah.
triggering sell signals. So it's the most important thing, because in hindsight, yeah, I mean, you can pull up a monthly chart and go, wow, I had Nvidia at 4 cents and now it's at $739, right? Look how great. The reality is it has gone through a number of these 50 to 70% corrections
Hmm.
that required, there's no way I'm going to hold through that. Kind of like you,
Hmm.
Justin. There's no way I'm going to hold through that if the stock is giving major sell signals, breaking the 50-day on heavy volume. The market's going in correction. All of my other stocks are hitting major sell signals. I'm just going to get pushed. The market's going to push me out, right? And now the key is, when does the market pull you back in too? And so for an NVIDIA, keep it simple, kind of like what you were talking with Bill. NVIDIA formed a cup. That was the first base it formed in over a year. So that was probably the first the first kind of traditional entry that you could have gotten into it.
And it was back above its 40-week moving average line.
Exactly. Yep.
Yeah, so things were
So
pretty,
there are a few kind of things. Where this was tricky though for an NVIDIA was it had negative earnings at that
Yeah.
point and really low sales, right? So that's where the trick really was in that. And so that's where kind of the conviction would come in, where you started researching like, hey, like ChatGPT just came out. Everyone's going crazy over this AI thing. This maybe could be a big market, and NVIDIA's in the center of it all. Right. So maybe those could have given the convictions, maybe take a little bit a chance on it at that time. Maybe you don't go in super heavy because of the negative earnings and sales, and we're just kind of coming out of a bear market at that point. But when you start coming up with some other reasons to fully flesh out the idea, to get more conviction in it, that's going to give you a better chance. And then, of course, once it broke out, the behavior after it broke out was it was acting like a leader. It was given that leadership behavior that stocks over the last 100 years have shown. It broke out. It didn't. Once it broke out, it didn't look back. Right. It didn't come in and build. Go sideways a little for a while. It got past that 190 area, took off, went 3 weeks tight. So it spent a few weeks there. Went 3 weeks tight. Then got past that, got through the next earnings. There was a little bit of an earnings gap there. Then it took off again, did another tight area, essentially put in a flat base here, emerged out of that. Then, of course, had that massive 30% gap up, went tight again. These are all things that I remember, Justin, when Bill O'Neill used to teach the seminars, he would highlight all these things, right? Look how it went
He'd
tight.
go over past winners. And the reason, some people would be like, why are you going over all this stuff from the past? Because it repeats. It's, the same stuff happens over and over.
And NVIDIA's perfect example of that, right? And how many weeks in a row is this? 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks in a row. I could see you marking that up, Justin, in one of those books 10 years ago, like highlighting that. And you're like, oh, of course it's there, right? But yeah, you're exactly right. It showed the technical action showed the same characteristics as many leaders of the last 100 years.
And maybe talk about, okay, so there's a lot about these leaders that, again, history doesn't necessarily repeat, but it certainly rhymes, as Mark Twain said. But what is consistent sometimes is kind of this strategy, what we're looking for, the elements of the story, the chart, and everything like that. So maybe, to just kind of wrap up this block here, talk a little bit about the things that are kind of consistent for you, and the things that you're kind of more committed to, as opposed to the stocks where those are going to be changing in terms of who's your flavor of the month, I guess.
So the things on like kind of a routine perspective, or just
and just strategy in general, because I think what can happen with a lot of folks is they have almost strategy drift. They kind of like, oh, you know what, my growth system isn't working right now. I'm going to switch to value because that seems, and I think that's where some people will really fall astray, because they're trying to chase what's hot right now, as opposed to sticking with a certain strategy and really kind of getting to know that well.
Yeah, I think the reality is that in the end, you're only going to truly develop an expertise in something if you stick with it, right? And go spend the years on it, 10,000 hours, right? They say, to become an expert at something. So the style drift, the strategy drift, you have to be very careful, because it's very easy. The markets are always changing, where it's going to reward one strategy over another, right? And so there are times where the O'Neill strategy, O'Neill methodology, IBD methodology is just not going to work as well. And a value strategy might work well, or some other kind of strategy, right? And so you have to be aware of that. But if you keep jumping one strategy to another, you're not going to really develop an expertise and spend enough time observing and making the mistakes and really develop that. Now, that being said, I mean, I felt guilty to this too, where uh, we were in this 2022 bear market where I think all of us became macro experts.
Yeah,
Right, and this was the
right.
first time I've really ever even paid a lot of attention to macro, but I spent hours trying to learn about macro and all this kind of
Mhm.
stuff. And while it's interesting and while it's useful to a point, I feel like it hurt me
Yeah.
in the end, because it caused style drift for me too,
Mhm.
where it pulled me away from the methodology, and I wasn't as pure. And so when I saw the follow through days, when I saw the breakouts and things like that, there were voices in my head like, yeah, but those interest rates could keep going up, right?
Mhm.
Or something else, other macro thing. There's obviously a recession coming in 2023, right?
We
And
have the
so
inverted curve, and
it's
there's an inverted yield curve, this is what
exactly.
happens. Yeah.
I mean,
Yeah.
Justin, when we started IBD Live, we were all on IBD Live in 2019, 2020.
Uh-huh.
We were never talking about yield
Interesting.
curves on right?
Right.
Now every
Yeah.
day we're always talking. When I listen to you guys, there's always some kind of macro thing coming, and while
Yeah.
it's very interesting, it's just very interesting how we've all become that because of just these unusual kind of environments over the years. So I think we've all kind of fallen into that. I've definitely I was definitely pulled away because of it. Um, where looking back, I would have done even better if I just stayed pure
Mhm.
method, the IBD methodology, right?
Mhm.
Just listen to Bill. Look for fall through days. What are the stocks that are breaking out? What are the ones that have the strongest RS lines? Which ones had that game changing potential? And you would have naturally, one of the ideas that would have been kind of flashing on your screen was Nvidia at that
Yeah.
time, and there are a number of others,
Mhm.
but that in the end, it just reconfirmed to me the genius of Bill, where
Mhm.
because and I'm sure you've seen these, Justin, but just to give some perspective for the listeners out there, yeah, Bill O'Neill, as part of William O'Neill and Company, he would write a lot of his thoughts. Right, he would kind of give his weekly update on the
Mhm.
markets, and I saw some of these that he wrote like in the 70s, and it was so macro. There was so much macro
Oh,
in it,
yeah.
right?
Mhm.
And so he had all this amazing knowledge of just macro and the economy and stuff
There
like
was
that.
a famous Wall Street Journal ad from 1982 where he was like, "Okay, it's, the 70s mess is over. It's time for us to go now," And
Yeah,
it was
yeah.
it was it was I mean, it was the weirdest ad ever because it was so full of words. There was like no white space.
Was that the one with the gloomy bug
The
where
gloomy bug, yes.
yeah,
Uh-huh. Yeah.
and he called that bottom perfectly. But I don't think that people truly understand how much of an stock market expert Bill was outside of the charts, right?
Mhm.
He was an expert at a lot of the macro, a lot of the fundamental. He would project the earnings out
Yeah.
and things like that we don't necessarily do all the time. But the genius of Bill was he took all that and simplified it and said, "Hey, this is really all you need to know.
Mhm. Yeah.
Focus on these monster earnings, monster sales, the ratings, the technical action, and the market, and you're going to end up in these biggest leaders. And you don't necessarily need to have all this other information out there to find yourself in an Nvidia."
Yeah, absolutely. And, just to kind of wrap a bow on this, I think at the end of the day, one of the things that can happen with macro is you end up thinking a lot about what should happen as opposed to what is happening. And Bill was a very big proponent of, not trying to analyze what is going to happen, targets of, the Dow is going to be at this level. It's, hey, what is the market doing right now, and analyzing it on a daily basis to that degree. So when we come back, we're going to talk about a few of the stocks that maybe deserve some love. So stay tuned. We'll be right back. Welcome back to Investing with IBD podcast. It's Justin Nielsen here, your host, and we've got our Valentine's Day special here, along with Irusha Peiris, who joins me every week. He's an analyst and portfolio manager over at O'Neill Global Advisors. And in the last segment, we were kind of talking about finding those stocks that are attractive. And sometimes it just reminded me how Bill O'Neill, the founder of Investors Business Daily, used to go through chart books. There was this big red maroon book, and he would go through those charts. And it kind of makes me think of, what the kids nowadays do on Tinder, right? They swipe right, swipe left. They're looking at the chart, not the charts, but they're looking at the attractive potential mates and stuff. And what Bill would do is he would kind of rip out those pages sometimes and say, hey, this is one that looks good and interesting. And so for those of you that haven't been on Tinder, I haven't myself, but that's the way it works. And so we're going to kind of go through some of the stocks that look a little bit interesting. One of the ways that we do that is either we look at chart books, or on MarketSmith we go through the space bar, right? That's kind of our swipe right and swipe left. You can flag things that look a little bit interesting and go back to those that are worth more research, getting to know them a little bit better. So since it is Valentine's Day, let's go ahead and start with, are you going to be going out to dinner tonight, Irusha?
No, I don't think tonight. We're going to postpone it till the weekend. So
I do the same thing.
But but in this case,
I never go out on Valentine's Day. I'm like, you know what? I don't want to deal with it. So tonight we're making a cake with Nicholas. Nice. It's heart shaped. So that's what our festivities are going to be. But maybe some people are going to go out to sushi, and KRUS is kind of an interesting pattern here. I mean, there's a lot of the restaurant stocks that have been looking interesting. I personally own Chipotle, but I don't think my wife would be okay with me bringing her to Chipotle for Valentine's Day. That just doesn't necessarily.
Well, I mean, even if you got some guac.
Yeah. Well, you know what? My mother-in-law lives with us. I mean, you can't you can't mess with her guac. I mean, she's full on Mexican. I mean, come on. I'm going to get it straight from the source. But let's take a look at Kura Sushi. The ticker symbol here is KRUS, and I mean, this has been kind of a little bit choppy, a little bit a little all over the place, but they have an interesting concept. We have one not too far away from us. It's kind of interesting. You got a robot that comes and delivers your drinks, and you've got a conveyor belt where you're just like kind of grabbing stuff as it comes along. You can order stuff and it zooms it out to you, and you just put your plates away at the table, and it kind of keeps track of everything. A lot of automation in this restaurant. That's kind of cool. But does this chart grab you? Is the chart attractive?
Not necessarily. It's strong. It's been very strong over the last few months here. So that part is interesting. It does have a strong relative strength line. And so those parts are interesting. But that's kind of the character of the stock here. It looks like it's just been in this large trading range for the last year or so, where it drops down to around 40, runs back up to 100, drops back down to 50, runs back up to 100. So I want to settle down a little bit and put in a base before I would really consider it. So yeah, this has come up on the radar for me a number of times. I was like, well, who are these guys? So but I'm never going to restaurants. So that, I think that's a great example there where you can develop the conviction in a stock. Because Justin, like if you bought it, I would say you would have a much better chance of holding it than me, because you've gone to the restaurant, you've seen some of the newer things that maybe are not in other restaurants. And so when it pulls back, you might hold on to it while I just probably might sell and run for the hills at that time. So yeah, but get on a technical perspective, and really even from a fundamental perspective, not necessarily there just yet, but it does have enough things that I think it's worth on and watch. Now, the other negative thing I think for me is that it's a $1 billion stock. And so with the small cap still struggling and trying to get going, and me, myself, I generally do better in larger cap stocks. This would probably be a little bit lower on my radar.
Makes sense. You know what? Let's take also a look at Cava Group. This is a more recent, IPO. And I think, there are these stocks sometimes where maybe they don't have the earnings yet. But, when you think of restaurant stocks and some of these retail concepts, it's the expansion, right? If they expand their restaurants, I mean, this is again what kind of attracted me about Chipotle back in 2010 was one of the first times I bought that. it was that expansion phase that it was in, and Cava certainly seems like it might be, potentially doing that. It's almost like a similar thing where, okay, we've got kind of the fast casual Mediterranean. Is this something that's more your speed?
Well, I have a little bit more conviction in it, Justin, because I just went to Cava last night, and the
Okay.
place was packed.
Okay.
And so I've started eating. Maybe it was only like maybe a couple months ago where I actually finally. It's been there for a while, but I just kept ignoring it. But I went a couple months ago, and I was like, "Wow, this is actually pretty good." It is very Chipotle-like, right? The setup is all very
Hmm.
similar and stuff like that, and the food was really good. A little bit more expensive than a Chipotle, which I don't necessarily like. But for a stock, that's better. The more pricier it is,
Yeah.
in my opinion, a lot of times that gives it more power to the stock when they can get going, or their kind of their potential, because they have that pricing power and the maybe even that more premium type of brand there. But so I think it does have a lot. It has potential here. I'm not sure if it'll get as big as like Chipotle, but I do own shares of it. Even as an analyst for William O'Neill, we just added it to our focus list there because it just
Okay.
has a lot of those O'Neill rate. Oh, it kind of has that what we're looking for from an O'Neill perspective, right? Where
Mhm.
it's a new concept. As you said, it's a new store where there's plenty of room for growth. They just started getting some triple digit earnings and sales. The ratings are okay here. And a lot of people that I've spoken to, they still haven't seen a Cava because they're not in their states just yet. Now it is, and it finally, of course, broke out of a base here too. So I think it does have some of that potential, and I've tried it now, so I have a little bit more conviction to it.
Mhm.
And so this one is a little bit more appealing to me from a stock perspective.
Okay. Well, you know what? What's interesting is there are a few of these stocks. Okay, this is an IPO, and again, this is kind of a newer thing, but you have had some IPOs of stocks that have been around for a while. And I'm going to kind of make a little transition. Hey, like the hippies, with their free love and everything like that. Maybe they were mostly barefoot, but maybe they were wearing Birkenstocks. So BIRK. Look, I had my first pair of Birkenstocks 30 years ago. I mean, I was wearing these shoes, in college in the 90s. So this is it's not a new concept, it's not a new company, but it is a new IPO. So talk a little bit about is this fresh enough? I mean, it's certainly this group, and you got to look at Deckers and some of the leaders here. I mean, Deckers is definitely one right now, but is Birkenstocks maybe gonna capture some of the move that Deckers is seeing? And is it maybe an old dog learning new tricks?
It's the things that Birkenstock has going for it is that brand name, right?
Yeah.
So it has that strong brand name. We all remember it from years past. I've never had Birkenstock, but I remember a lot of. I remember it was very stylish, like 30 years ago, probably when you were wearing them, Justin. So it was one of those things to have. So I was kind of surprised that they were coming out public now.
Well, and there's a lot more different selection. I mean, a Birkenstock 30 years ago, it was a
Just the
Birkenstock. There,
sandals,
there,
right?
there was
Yeah,
one look to it, just like
yeah.
Crocs used to have. I mean, Crocs were Crocs. You didn't
Yeah.
have all these different styles. You didn't have platform shoe Crocs and all these different things. But Birkenstock has now kind of got a lot of different styles to it now.
Yeah, I think it has potential there. It is setting up a base. It went tight for a few weeks here on the weekly chart. They have some really good earnings here. Then going back to kind of the question with Deckers, there is this underlying trend going on with footwear where people are willing to pay premium prices
Mhm.
for shoes, right? So you can see that with a Deckers and a Crocs, right? And I guess in the middle tiers is a Skechers, which that they're competing like in the around the $70 range. But Birkenstock, I'm not sure exactly how expensive they are, but I'm assuming they're probably in the $100 range, around there. So I think it does have a lot of the things that we look for in the stock. Now the key is go and do that research, but it's definitely one that's worth adding to a watch list.
Yeah. And you know what? I just went onto the website and I'm seeing $159 for the Birkenstock Boston clog.
There you
Looks
go.
like you've got $110 for the Arizona dark brown two-strap sandal, $110. So yeah, I mean, you know, they're that's not what I paid for my Birkenstocks. Let's just say
And I don't think that's what the hippies and the going to
right,
Woodstock
exactly.
were paying.
Yes, yeah. And I was at the 25th anniversary of Woodstock, and I think I did have my Birkenstocks on that trip. So, okay, let's go ahead and wrap it up. It wouldn't be a Valentine's Day special without a little bit of love. So let's take a look at LUV, Southwest Airlines. This has been one of those. I mean, it's still in a downtrend, but the travel, leisure, the hotels, they've been trying to perk up a little bit. So this is a base. Has it put in its bottom finally?
I think it's still a little too early here. Now it is starting to make a little bit of higher highs, but I would be more comfortable with on a technical basis with this stock if it started taking out like those 40 levels, right? Because now it's truly established a higher high at that point. You can see the pattern recognition drawing a cup here. So probably a little bit too early, but the relative strength line is making some shorter term highs. It looks like it's had a positive earnings for the first time in a while. And so here, I think the best thing they could do is just start going sideways, maybe establish a new trading range and emerge out of that, and now start slowly changing the character. So probably too early at this point. But some of the other airlines have been acting a little bit better, so maybe there's a little bit of chance. But overall, the airline group in itself is only 120, so that's another negative to
Mhm.
it. So this is one add to the watch list. Keep it on the radar. Maybe in a few months, maybe next earnings report or something that maybe that'll give it more of a catalyst to slowly start making its way back up.
Yeah. And just like, you said, there are definitely stronger airlines out there. In the discount space, you got Ryanair, RYAAY. That's a very different looking chart. I
Yeah,
mean, this
there you
has
go.
been in an uptrend, relative strength, really powerful. SkyWest, SKYW, very different looking chart. I mean, this has been on a pretty good tear, a little lower in liquidity, but certainly, I mean, it's been acting really really good lately. It's a $2 billion market cap stock, but really strong uptrend, had its base, and is been holding the 10-week moving average line very well lately.
Yeah, these are exactly the type of charts that you want to look for. So a lot of times you may find an interesting idea, but what you want to do is go through the whole group, because there are times where you'll find an even better idea within that group. So that was a perfect exercise right there, where you see Southwest. There's like, oh, it's kind of formed the space, but it's a laggard versus the others. And in the end, the goal of for all of us is we want to try to be in the leading stocks, not only of course in the overall market, but even within the industry groups. You want to try to be within what's the leading stock of that industry group, and right now it's not necessarily Southwest.
hmm And this is one of the things that I like to do is you see on the left hand side of the weekly chart, for those of you that are looking at the video, which you can always find at investors.com/podcast. You can see, hey, who are some of the leaders in the group, and love is there.
Yep.
But it's, you also have Hawaiian, you have Ryanair, you have SkyWest, that are going to show up to kind of let you know, hey, here's some other areas that you might look at to see if you can find stronger. Very good. Well, hey, Arusha, I hope you have a great Valentine's Day. Enjoy your evening
Same to
tonight.
you,
Hopefully
Justin.
our producer, can wrap up his work here and actually enjoy some of his Valentine's Day as well, before it turns midnight. But thank you all for joining us for this episode, and hope you tune in next week, because we've got Eric Kroll coming back to the show. Of course, Eric Kroll is he's been a long time fan of IBD, and he and some of his friends have written a book, The Life Cycle Trade, where they did a bunch of research. He really digs the research and has been very successful on his own, in terms of his own prop trading and everything like that. So it'll be great to talk to him, and we hope you join us for that. Thank you for joining us this week. We'll see you next time. Bye-bye now.